Not sure if you've been watching, but the 10-year note has been on an absolute tear recently. Just this morning, it has peaked over 4.2. Again, it was just 3 weeks ago where the 10-year note was bouncing around 3.6, 3.65, something like that. And now it's over 4.2%. Why is this important? Well, for the first time in perhaps a year, we need to start talking about 30-year mortgage rates having a 7 handle. Yes, folks, just before the Fed rate cut, we had mortgage rates at 6.11. Now, 2.5 short weeks later, we are looking at mortgage rates perhaps heading towards 7%. And again, that's 7% full down payment, best credit. Lots of us don't have that and would see rates in the 7s already. Investors very likely are in the 7s. So let's have a conversation about what happens to the real estate market if rates average higher in 2025 than even I predict. Again, I have talked about mortgage rates in 2025 being, around 6.2, significantly higher than most experts. But let's at least pretend for a minute that we're all wrong and mortgage rates are maybe, say, 6.8 to 7.2. Again, these are conversations that I don't think happen, but we at least need to think about them. And the first thing that I go back to, again, in this higher for longer, no landing camp is we're going to see some pain. And I don't mean price crash. I know everybody wants a price crash. That is not going to happen, at least in entry-level single-family home. It's probably the most secure real estate asset today. 30-year fixed rate debt. Everybody's got a 2, 3, or 4 handle. I'm sorry to inform you, entry-level housing not going to crash, in my opinion. That said, there are plenty of real estate deals that were done with bad assumptions. If we stick to single-family homes, you will know that a lot of people went into Airbnb, short-term rentals, STRs. In fact, I'm reminded of a conversation with Pace Morby just 48 hours ago, where he highlighted that he is getting out of the short-term rental game because of rules and regulations that are changing and making it a lot less profitable. I suspect that there are a lot of short-term rental operators that are in deals that probably don't make sense given what is going on in that environment. Now, of course, it's not all, it's probably not even half, but it's many. These operators are going to have a couple of choices. They could switch up the game and go furnished midterm rental. Absolutely a possibility, and many will choose that. You might even go furnished rental, long-term rental. That is an option, not something that's typically done. But again, if you have it already furnished and it's nice, maybe you choose that. I suspect many will simply choose to list and sell. Now, we're going to figure out who wants to sell and who needs to sell. That is going to be the big decision. It will be very much like the Great Recession, in my opinion, where the first ones to list will have the least amount of pain. I suspect a lot of operators will act like, most humans, and they will hold on and hold on and hold on, and then be forced to make that decision when there's a little bit more stress. So I do think there is some more inventory, perhaps some more motivated sellers coming in the STR space as that market starts to shake itself out. That said, that's going to be probably a rounding error. It's going to be rather small, but hey, if you ever wanted a nice home in, I don't know, Lake Havasu, Palm Springs, any of these really, once hot STR spaces, congratulations. You probably can find a motivated seller. Where the real pain is going to come with 7% mortgage rates is, of course, the commercial real estate market. We have been talking about this coming for quite a while. And if we have commercial real estate markets at 7%, that's going to be no bueno. No bueno. A lot of people in the commercial real estate space that I talked to off the air and off the record, frankly, they were all, I don't know, praying for lower rates, right? They were basically saying things like, man, if I could get something in the high fours, I think I can hold on and wait this thing out. I won't lose the property. Well, if you were hoping for 5, lower than 5, and now it's 7, and rents are getting soft, as we've talked about on this channel, NOI is going down, you're going to very quickly run into a scenario where you have a large cash in refi, or you need to sell and likely lose all of your equity and perhaps have the bank short sell it. It is going to be bad in that space. I do think the 5 to 40s where I play. I don't play in the Ken McElroy, the Pace Morby, the Grant Cardone area. They're very up there in the Class A stuff. I want to play in the 5 to 40, Class B, Class C. That stuff's going to start trading, and I think people will be shocked. People will be shocked. Again, I say this as someone who experienced it. You can read about it in my first book, One Rental at a Time. The single-family market crashed first, but what people don't remember is the multifamily crashed about 18 months after that. Because, again, the operators were just holding on for dear life. And you can get some wild deals, right? We bought an 18-unit building for 50% off. We bought 2 10-unit buildings for about 80% off, maybe 75% off. The 18 was full. The 10s were empty, hence the difference in price. But again, you could get full financing. We got both properties, all 3 of those, the 18, 10, and 10, fully financed. We just had to, in one case, we had to deposit money at a bank. In the other case, we had to escrow some repair money. But it's all out there. It's all possible. So again, lots and lots of stuff going on. If we do have higher rates, close to 7% for 2025, please be aggressive. Follow up. Track stuff. Watch days on market. Again, we as investors, we as One Rental at a Time, we simply do not care about the cost of capital. Our job is to write great offers that make sense today at today's rates. And of course, whenever possible, to get 30-year fixed rate financing. In addition, if we have rates above 7%, transactions are going to crash. Right now, we're talking about transactions. I think we get pending home sales later this week. Might be tomorrow, actually, or might be Thursday. I forget. Anyways, it's coming. And we're going to see something below 4 million. If we have rates at 7% for 2025, we're probably going to have transaction volumes fall to 3.5 to 3.6 million. It is going to go ice age. Again, folks, if you have not downloaded the 54-year spreadsheet, which I give away for free on my website, onerentalatatime.com, I don't know what you were doing. And if you're going to go download the spreadsheet today, I would ask you to look at the existing home sales from 1978 to 1982. What is relevant about that time frame is we obviously had the transaction crash, but we had kind of a step function. They went down hard, but then they went down hard again, ultimately going down 50%. So again, if you remember where we were kind of peak existing home sales, it was like 6.3 million, something like that. So if we were going to take the 81, 82 time frame and think 50% off, we're going to get down to 3.2, 3.3 million sales. That will be ice age levels. So again, lots of stuff going on, lots of stuff to be paying attention to. So I just think it means opportunity. At the end of the day, I know there's going to be a lot of people, a lot of doomers, a lot of crash bros talking about pricing crash. And of course, they're going to have PTSD from the Great Recession. And it's just not coming. We are not going to have the required wave of distressed inventory hit the market. Will there be pain? Yes. Will there be foreclosures? Yes. Will there be some people like us who buy amazing deals? Yes. But in an environment where you have 4 million, 3.5 million transactions, there's not going to be a large enough percentage of distress. There will be distress, but not enough. For example, as of right now, and we have plenty of doomers plenty of doomers talking about foreclosures going parabolic. As of right now, the last report, percent of total loans in foreclosure is 0.43. Less than 0.5%. It's crazy to think about that. Less than 0.5%. Now let's talk about why that is. Well, again, as I've tried to highlight over the last 3 or 4 years, the lending institution, the banks, are simply operating different. In an environment of the Great Recession, it was get 90 days late. Your chances of foreclosure were 91%. 9 out of 10 people who were 90 days late in the last cycle got foreclosed or short sale. Today, you go online, you click a button, you get a forbearance for 6 months. You get a forbearance for 12 months. Banks are simply not going to allow the required wave of inventory to hit at one time. And it doesn't matter what the doomers and crash bros say, the banks are acting different and they won't let it happen again. It's just, don't stop watching. They just don't understand. They all have PTSD from a bygone era that unfortunately, or fortunately, depending if you are a buyer or seller, won't come back again. Okay? So it is what it is. I do want to congratulate somebody for getting a deal done. I love sending these out. Greg, congrats for getting a deal done. Thank you for doing the work. Let me throw up the little banner for you. There you go, Greg. Congratulations for getting your deal done. Your card will go out in the mail. Again, I send black cards for every second deal and on. You can get as many of these as you want. I do send out golden tickets when it's your first deal. So again, if you have one of those, reach out to me. I do need your address, and I'll mail you a card and give you a shout out on this channel. Let's talk about Fed speak. Lots and lots of Fed speak. I mean, I think I read 5 or 6 different Fed speeches all over my notes here. Let's go to Mary Daly first. Mary Daly is, well, actually, let me preface this. What we are starting to see in Fed speak is a bifurcation. And this happens at transitions. We saw it in the last Fed meeting where Michelle Bowman officially dissented. We learned in the Fed minutes that many others were not leaning towards 50, but ultimately went that direction. We are going to start to find out which Fed presidents are bulls, bears, hawks, doves, whatever you want to call them. So Mary Daly, I think she is the most dovish as of right now. Why do I say that? Get this. Mary Daly strongly favors another 50 basis point cut. Think about that. I did not have that on my bingo card this morning. She sees no reason to stop cutting. The expansion phase is not over. She actually had a presentation where she went in and basically said, hey, we're something like 84 months into this expansion. Most expansions are a decade or over 100 months. We still have room to run. To which I think, really? If we're still in an expansion, why the hell is the Fed cutting 50 basis points? But hey, I wasn't in the room. I couldn't answer that question. And then finally, she did highlight that consumers are continuing to spend, but they are trading down. That is important information to think about. Think about going to Costco and instead of buying steak, you are buying chicken. Just a cheaper protein, for example. How about Neil Kashkari? He's always fun to listen to. He's basically saying, hey, we are going to have a slower pace of rate cuts coming. He is definitely angling for a quarter versus a half. Kashkari also said, we want to avoid a recession. That is why we cut 50 last time. How about Jeff Schmid? He doesn't talk a lot, so it's interesting when he gets out there. Jeff Schmid said, like to avoid an outsized move. He doesn't want to go 50, but he also says, this is probably a hat tip to Michelle Bowman, the neutral rate is well above pre-pandemic. And if you remember the neutral rate, folks, 2019-ish, it was often thought that the neutral rate was about 2.5, maybe 2 3/4. Now there's a lot of people talking about it being 3 to 3.5. Michelle Bowman and perhaps Jeff Schmid actually think it's 4%. That's a big difference. That's a lot less rate cuts. Pretty interesting. How about Lori Logan? Lori Logan is out saying rates will be falling gradually, or I should say rates will be lowered gradually. Again, talking about the front end. Folks, don't forget, the Fed controls the very front end of the curve. They can cut and mortgage rates can go up. See earlier part of this conversation. Again, the Fed has cut. The 10-year has gone from 3.6 to 4.2. Mortgage rates yesterday were 6.82. Yes, heading to 7% perhaps. Let me see. Do I have any more Fed speeches? Oh, yeah, one more from Neil Kashkari, a different article. Labor market didn't cause inflation, right? There was a lot of worry a year or two ago about the feedback loop of wages impacting inflation. Again, as an economy that's based on services, wages can be a big part of inflation. And Neil said, nope, not this time. Folks, if you are a school member, remember we had a live Q&A yesterday that is now posted in our school. If you go to school, you look under classroom. There is an icon that says live Q&A, and it has somebody created like a drawing of me. Click on that. You will see a full list of Q&As. You just click on I put a date on it. You can get it there. There you go. I do want to congratulate the school members. We went over 300 yesterday. 300 school members. Don't know why you're not a part of it. 67 cents a day to be among these amazing folks. Live Q&As, all these amazing things. I want to congratulate Gloria, Melvin, Jacob, and Robert, all for joining in the last 24 hours. You guys make the community grow. Introduce yourself. Remember, when you're in the community, you got to get to level 2 to unlock 6 hours of creative financing, and level 3 to get a $1,000 10-week boot camp replay. So go get those things. They are full of value. Let's talk about some earnings. It is earnings seasons after all. We kind of got the tale of two tapes. General Motors beat top line, bottom line, and raised earning guidance for 2024. I thought that was interesting. Obviously, autos, a lot like housing, are impacted by rates. But again, GM is likely buying down rates with their own financing and the like, hence moving inventory. And then, as I talked about over the weekend, the one I was looking forward to was Sherwin-Williams. Sherwin-Williams obviously is a paint, right? They do paint. I was like, hey, are they going to tell us what's going on in housing? And sure enough, yuck. Missed top line, missed bottom line. Top line, a.k.a. revenue. Bottom line, a.k.a. earnings. And the coup de grace, they lowered guidance. Yes, folks, less transactions, less momentum, less interest. It certainly looks like housing is slowing down. We are starting to get some earnings from that second tier of banks or financial institutions. Zion Bancorp came out, I think it was yesterday. They too beat top line, beat bottom line. So we got the big banks doing great. We got the next tier, at least early, looking okay. So pretty interesting stuff. General Electric missed on revenue, but beat on earnings. SAP beat top line, beat bottom line, and raised guidance. Former Fed president of Boston, Eric Rosengren, something like that. Labor market is doing better than the Fed expected, and he sees the Fed going 25-25 to finish up 2024. One thing I did note is the market, the smart money, has actually removed 100 basis points in cuts from 2025. So they've taken out, which I think was originally 250 basis points or 10. Now they're pricing in 6. So again, I think the market is getting used to higher for longer. Anything else we want to go through? Nope, that's it. That's all I got for you guys. Again, don't forget, join school. Also, again, if you want to come be in real life, in person, we have that amazing Vegas event coming up February 15th and 16th. VIP is 50% sold out. General admissions about 20% sold out. So lots of spots to come. Again, trick about Vegas is if you buy your flights and hotels early, you actually can save a bunch of money and perhaps pay for the tickets with the travel savings. But yes, very cool stuff. Folks, I hope you have an amazing day. That is your daily financial news. Bye.